So this question, we're going to solve it. The Lebanese Bakery Inc. also allocates FMOH, which is fixed manufacturing overhead, to products on the basis of standard direct manufacturing labor hours. So let's just think what this means. We've got the fixed application rate, and this is calculated as budgeted fixed overhead divided by, and that's total budgeted. Let's change that to total budgeted fixed overhead divided by the total cost driver, which in this case is direct labor hours. And that's budgeted total. So budgeted total cost driver. That's how we calculate the application rate. And in this case, the fixed manufacturing overhead application rate is actually equal to $4 per direct labor hour. So they've already done the calculation for us, and they've told us that the application rate is $4. Actual manufacturing overhead incurred during the year was 272. So they make baguettes in batches of 100 loaves. And the following is some information. Direct manufacturing labor use is $2 of direct labor hours per batch. So that's batch of 100 loaves. And then the fixed manufacturing overhead, of course, the application rate is $4 per direct labor hour. The bakery recorded the following additional data for the year ended December 31st. The planned or budgeted output was 3 million. So this is budgeted. And it was 3,840 baguettes. But keep in mind that we're looking at batches, and each batch has 100 baguettes. So we want to know how many batches there were. There was budgeted batches. They also tell us that the actual production, so this is actual, was 3,360,000 baguettes. Again, we want to determine batches. So if I look at this, this is equal to 33,600 actual batches. Then they tell us that the direct manufacturing labor was 5,400 hours. Those were the actual hours that were worked. And then the actual fixed manufacturing overhead is 272, which we already knew from up here. And then it says, prepare a variance analysis of fixed manufacturing overhead costs. So first we have to understand how to calculate this. We can't use the diamond approach. We have to use the column approach. So I have that down here. So this is the method we use to calculate the fixed overhead variances. We've got actual, the master or static budget, and then we have the flexible budget. Looking at this, we need actual production multiplied by the actual cost driver multiplied by the actual application rate. Now, we don't have to calculate this in most questions because they usually give us the actual. So we have the actual right here that was totally spent. So I already know what this amount is. This amount, and I'm going to move these words down. So this amount, we already know that this amount is that 272,000. That's what the actual is. And don't forget, that is the actual production in batches multiplied by the actual cost driver multiplied by the actual application rate. Now, the static budget is the standard production. Well, remember, it's batches. Standard production, we already know what the standard production is in batches. It's right here. It's the budgeted, 38,400. We're going to multiply that by the standard cost driver per unit, which we were given. The standard cost driver per unit is 2 hours, right? Direct manufacturing labor use. Standard is $2 direct labor hours per batch. So we already know what the standard is. It's 2 hours. Direct labor hours. Let's put direct labor hours. And then we're going to multiply that by the standard application rate. We know the standard application rate. It's right here, $4 per direct labor hour. So if we multiply all of these out, we can see that the master or static budget says that we should have spent $307,200. Now, compare that to the actual. This is the actual. I'm just going to bring it down so that it's in line. So this is the actual. I'm just going to, yep, there we go. So now we can calculate the price variance. I just take the bigger number, subtract the smaller number. Here it is. How do we determine whether this is favorable or unfavorable? Well, I thought I was going to spend this. I actually spent this. So I know that this is actually favorable, significantly favorable, right? So keep in mind, this is a price variance, a fixed manufacturing overhead price variance. And if we spent less, it's a good thing. We do not change this for the level of activity, right? We do not look at actual production and compare it to standard production. Why not? Because we don't care. Fixed overhead does not change within the relevant range. So the only way it can be different is if we spent more or we spent less. In this case, we spent less. All right, so now let's look at the applied fixed overhead. This is the flexible budget. So we're going to look at actual batches, and our actual batches were 33,600. We're going to multiply this by the standard cost driver per unit. Well, the standard cost driver per unit is $2 of direct labor hours, and we're going to multiply it by the standard application rate. Well, the standard application rate is $4 per direct labor hour. So I can take this, I can copy it, I can put it over here, and I paste it. Oh, and I need it a little bit larger. There we go. So that is $268,800. I know this is the production volume variance. So I'm going to take the difference between these two, larger minus the smaller. I don't care if it's positive or negative. And I have to decide whether this is favorable or unfavorable. You can see that the standard cost driver is identical and the standard application rate is identical. If those two things are identical, the only reason that there's a difference is because the standard production and the actual production are different. Standard production and the actual production. How do we decide whether this is favorable or unfavorable? We only look at the thing that is different. When is it unfavorable? When is it favorable? This is a measure of how well we used our fixed assets, property, plant, and equipment, intangibles. That's what it's a measure of. So if I produce more units using the same fixed assets, that means I'm doing a really good job, an efficient job of actually producing the units. If I produce less than I had budgeted, that means I'm inefficient at the use of my fixed assets, and this is unfavorable. Now, what is the overall fixed overhead variance? This is favorable, unfavorable. They go in opposite direction. I'm going to subtract it, and I can see that this is unfavorable. So the overall variance, the fixed manufacturing overhead variance, is unfavorable by $3,200. Let's see what else. Item number 2 is the fixed overhead under or over allocated by how much? Well, when we go over here and we see this total fixed overhead variance, that is the over or under applied. So we can say to item number 2 right now, we can say the fixed manufacturing overhead is under allocated because it's unfavorable by $3,200. All right, go back up here. It says comment on your results, discuss the various variances, and explain what may be driving them. Well, I already explained exactly what this is, right? The production volume variance is basically addressing whether we efficiently used our fixed assets. And in this case, we can see that we were not efficient in using our fixed assets because we have an unfavorable variance. Why? Because we should have produced 38,400 batches and we only produced 33,600 batches. So we did not utilize our fixed assets efficiently. Over here, this is simply saying, hey, did we spend as much money as we thought we were going to spend? We thought we were going to spend $307,200. We only spent $272,000. That means that something like maybe our depreciation costs on our machines may have been, lower than budgeted. It means that the total of our fixed costs was lower. That's it for 8-18 fixed manufacturing overhead variance analysis. Remember, we can only use the column approach for the fixed overhead variances.